In Chapter 12, we're talking about special elections and postmortem planning. The first 3 learning objectives include identifying the liquidity needs of a decedent's family. And when we talk about liquidity needs, we're referring to the need for cash to pay bills. And those bills could include, all the things that we talked about in the last chapter. Income replacement, funeral expenses, funding goals, etc. We'll go into a little bit more detail on that in this chapter, but we covered it heavily in the last chapter. And then talking about liquidity sources and their implications. So sources of liquidity, obviously the easy one is life insurance. Again, last chapter. However, you might have enough cash in your estate to cover all of your expenses, including income replacement. Some people have enough money to be self-insured. They don't need life insurance to make it work. The other sources of liquidity could be illiquid assets that you have to sell. Remember that when we say liquidity, there's various degrees of liquidity. And in the principles of accounting, when you list assets on a balance sheet, they're supposed to be listed in order from most liquid to least liquid. So most liquid would be things like cash or cash-like securities. And least liquid would be things that don't have a ready market. You are not likely to be able to A, sell it fast, or B, be assured of what you're going to get for the thing that you're selling. So maybe it's a collectible. Like I was for a while. I was into those Department 56 houses. I don't know why. But like for Christmas, I had all of these like Christmas in the City buildings. And I just thought they were magical. And they've been sitting in my parents' basement for about a decade now. Anyways, they're collectible. However, I have no idea how much I could get for them, and it would take some time to sell it. So those I would consider to be my least liquid, among my least liquid assets. Anyhow, the point of this is the sources of liquidity and their implications. We'll talk more about that, but this is what we're getting at. How are you going to pay the final bills if you are the executor of an estate? Or if you're planning your own estate, what liquidity will your heirs have? What are you going to leave them with? Also in this section, describing an IRC Section 303 redemption. And this is really a sub-item under sources of liquidity needs and their implications, because we could put it here. And in addition to my Department 56 collectibles, we could add maybe your shares of a closely held business. And the Section 303 redemption is an election choice that you can make that helps mitigate the tax consequences of having the corporation redeem your shares. So that's what we're going to talk about in more detail in this video. So the liquidity needs of a decedent's family include things like last medical bills. Now, you might assume that a person has health insurance to cover this, but maybe they had a pretty spectacular death and incurred all sorts of expenses that are not covered. For example, if they died overseas and the cost to bring them home, or maybe even the cost of care overseas wasn't covered. Or maybe they decided to get some kind of treatment that is experimental in nature and just incurred all sorts of bills for it. Also, obviously, estate tax, funeral expenses, the cost of administering your estate. And this would include your personal representative and any professionals that you needed to help you, and also maybe probate, the cost of probate for any assets that pass through probate. And then finally, the needs of your surviving family members. So making sure that you provide not only the liquidity, but the access or easy access for your personal representative to be able to take care of the needs of your survivors. So sources of liquidity and their implications. It might take a little while for life insurance benefits to be processed. Most insurance companies, assuming it's not suspicious death, most insurance companies will accept a death certificate as evidence that the insured has passed. Then they'll process the life insurance benefit to the listed beneficiary or beneficiaries. So the question is, one, how long does it take for beneficiaries to get life insurance benefits? And I would say at the minimum, it's going to take 10 business days. Totally depends on the situation. And when you think of liquidity, of course, you think of bank accounts. You think of bank accounts being super liquid. Well, they are as long as you're able to access the cash. So if there was a payable on death form on file, or if it was jointly owned and the joint owner is still alive, then you can access that cash. And of course, there's little risk of erosion because it's cash. It's not like you have to sell cash. It's going to be there. And there's not really a tax consequence of using the cash. It's not like there's a cost basis and you have to pay the gain. Whereas with a brokerage account, you might be forced to sell a security at an inopportune time. So less appealing to have to sell stocks to be able to pay some of the decedent's estate expenses. And also, even though you get a step up in cost basis to whatever the value was on the date of the decedent's death, if the market raged and a month or two into the administration of the estate, you realize you need cash, and now you've got to sell an asset out of that brokerage account, you've got capital gains tax consequences. Probably not going to be a big problem, but it is a potential issue. So I should be marking these as I go along in terms of the taxes, the tax implications. Let's start with tax-free, pretty much life insurance benefits, tax-free. Using those to help cover liquidity expenses, no tax consequence of that. And using cash assets like bank accounts, really no tax consequence. There's no immediate tax bill that's due as a result of peeling cash out and using that to cover estate expense. And using brokerage assets, you have the potential of having to pay capital gains tax. So let's color that in blue. So capital gains. And then let's just add to this chart now ordinary income tax. Now, ordinary income tax rates are much higher than capital gains tax rates usually. And that applies to our next potential source of liquidity, tax qualified accounts. And specifically, we're talking about pre-tax holdings like traditional IRAs and traditional 401ks. Because there can also be tax qualified accounts that are only that have only Roth contributions. And that can be a Roth IRA or a Roth 401k. And in that case, that would be tax-free, but you hate to use those. So let's go back to the tax qualified accounts that are pre-tax. So if the executor needs to pull money out of a traditional IRA or a traditional 401k, ordinary income tax rates will apply, which is not appealing because you do not want to pay income tax at the estate tax rate. It quickly gets up to the maximum tax bracket of 37%. That's just with recognizing $12,950 worth of taxable income in 2020, which isn't very much. So if you need to take a withdrawal from either a 401k, a traditional 401k, or a traditional IRA, every dollar of that is going to be subject to tax. And if that's the only liquid asset that's available to pay estate expenses, you're going to have a huge tax bill paying for the federal and state, if there's state income tax in the state that the estate is being administered in, you're going to have a big tax bill. So this is really the last asset or one of the last assets you want to use. The other type of tax qualified account would be a Roth IRA. Now, because Roth IRAs, the deal is the money goes in on an after-tax basis, but it grows tax-free and the withdrawal is tax-free. It sounds like a reasonable option, but really Roths are precious and you want to let those things ride as long as possible, usually. But given the choice between liquidating a traditional IRA to pay estate expenses versus a Roth IRA to pay estate expenses, I guess if you don't have any other choice, you're going to use the Roth because it has no tax consequence. You're just giving up the future benefit of the hedge against tax increases. So another potential source of liquidity would be this Section 303 redemption. I mentioned before that this is related to a decedent who owned shares of a closely held C Corp. And in this case, in order to use this Section 303 redemption, they needed to have at least 35% of their estate or more be comprised of this closely held corporation. And if that's the case, then the estate will get special tax treatment on the redemption of the shares of that C Corp if the only purpose of it is to pay for estate taxes, administration expenses, and funeral costs. And what you end up getting with a Section 303 redemption is the opportunity to sell shares of the closely held corporation back to the corporation. Now, this assumes that the corporation has the cash in their, bank account to be able to buy out the decedent's shares. And instead of having to pay ordinary income tax, you get capital gains tax treatment on the sale of those shares back to the corporation. So capital gains tax treatment. So the only two types of assets that get capital gains tax treatment, brokerage accounts, and essentially, because we're talking about the same type of asset, the sale of stock back to the corporation. Right. Okay, to be more accurate, this source of liquidity shouldn't really be called a Section 303 redemption. It's the source of liquidity here would be the ownership of a closely held business. And so using that Section 303 redemption is one way to change the implication of the sale of a closely held business from making it ordinary income tax to making it capital gains tax treatment. Okay. So there might be other assets that are part of the estate that you could liquidate. Real estate, other businesses, art, cars, etc. And the implication of selling those assets is the tax implication if there's a gain is likely to be capital gains tax treatment. Really depends, because if you've got inventory from a business, technically that would be considered income tax treatment. But the bigger issue is that these assets would take a long time to sell, potentially, and there's not a ready market for them. So you're really not sure what you're going to get. So that's the quick take on liquidity sources and their implications.